Hey Orlando, welcome to the guide for your first home. Whether you're moving to town for the first time or you're a first-time home buyer, I'm so excited to have you here on this conversation where we're going to talk about how to buy your first home, or if this is your second home, how to make sure that you're setting yourself up for success. When you're getting ready to buy your first home in the Orlando or the Florida area, there are a lot of pieces that you need to be paying attention to as you go along. And so many people start getting the cart before the horse because they decide to go out and search for a home first or engage a realtor first to be able to go down that path. While the realtor is an important component of this real estate transaction, they're actually kind of like putting the cart before the horse because they're 100% commission salespeople that want to help you buy a house in a really bad way. But the first thing they're going to do is send you right back to me or to somebody like me who is a mortgage person who is going to be able to help you get set up for success in buying your home. So really, why don't you just put the horse where it needs to go and put the cart where it needs to go and do the right thing and search out for a lending partner to get pre-approved. That is actually step one in the process, is getting pre-approved. So let's talk about what we have to do to help you get pre-approved and how we get you set up for success. Regardless of how many homes you've purchased before, there are three aspects that every lender is going to be looking at in your file. Now we call it file. It can feel very personal, but it really truly is your file. We're going to be looking at credit, we're going to be looking at income, and we're going to be looking at assets. So those three components right there, credit, income, and assets, are going to be the most important pieces that we look at, and we're going to talk about some of this in a little bit more detail. For example, credit being the first piece. Credit is what's going to open the door. Now there are a lot of great apps on the market where you can actually go in and service and actually check on some of the stuff that's going on in your credit, and those are really good things for you to consider to do. Now keep in mind that there are 13 versions of FICO. Credit Karma, CreditWise, some of these other apps, FICO, even the FICO versions, they're not all the same. The FICO versions that are used for the mortgage are FICO 2, 4, and 5. And so that's actually a really good piece to understand because the Credit Karmas of the world or the CreditWises of the world, those are really promotional scores that are not really driven to help you with the actual mortgage itself. They're really just more of a reference. They're a reference of how your credit is working, how it's managed, and it's a really good way for you to stay in touch with your credit. Now, having said that, if you go out and fill out an application, you have given Credit Karma the ability to track your information. And same thing with CreditWise. So if you fill out an application for a credit card or a car loan or for anything else that's mortgage, or not necessarily mortgage related, but credit related, you're actually going to be probably getting notices from other creditors wanting to sell you these pieces of other credit. So just keep in mind that these services, while they're free, many times there's a hook attached to that and they're using that to sell your information to others. Now, it's not a bad idea for you to go check out your own credit. So how can you do this if you don't want to engage with Credit Karma or CreditWise? Well, there's a great way to do that. You can go to annualcreditreport.com and pull your own credit there. You can do it once a year for free. It can be a little difficult to read, but if you want to, it's amazing in the data that is in this credit report. It's not going to give you the mortgage points, it's not going to give you credit scores, but it is going to tell you everything that is on your credit. And that's actually pretty important because it gives you an opportunity to take a look at it and understand what it is that's affecting your credit so that you can pull forward and you can make a really good decision on how to clean your credit file up before you get going. And that's probably a good idea to do this before you get too far down the road. Now, a mortgage lender is actually going to look at your credit and they're going to be determining based off of your credit what kind of a risk factor you have associated with buying this home. Can you buy without any credit? I get that question a lot, especially the Dave Ramsey followers who are really trying to buy a home without any credit. The answer is yes, you can buy a home without any credit. You are going to be limited, however, because when you're getting a no credit mortgage, in essence, we still have to establish credit. We have to establish that you have a pattern of repayment. That pattern of repayment, in essence, what we're going to be doing is we're going to be looking at insurance, make sure that you have car insurance for the last 12 months, make sure you've made your payments on time, maybe a contract with a cell phone, maybe you have Verizon or AT&T or T-Mobile or one of these other providers. You can't use the monthly ones, But if you've had a 12-month contract and you've maintained it with them for a long time, that'll work. We can even use gym memberships. I've used Netflix. Utilities is actually very common. Rent is also very common. So can we do that? Yes, we can. Now here's the downside to no credit. They're looking at it as if you have a 580 credit score, which is not going to give you the best terms on the market. Does that mean that you can't? No, you certainly can, but the more perceived risk somebody has with their credit file, the more the bank is going to charge you when it comes down to your actual loan. So that's actually pretty important. Now, where credit starts improving and we start seeing terms get better is around the 620 mark. And I have a great friend that has become a friend over the years that I actually helped in a situation like this where he was below the 500 credit score, and we were actually able to help bring him up when it came down to it. It took a little bit of time. I had to show him what was going on with his credit. I had to show him what was going on with his file. And in essence, he took a little bit of time and actually worked through it and made improvements on it so he could get his credit score up above a 620. Now, that was perfect because he was able to snatch up a house once he got in there, and then when the terms refinance, when things got better for him, he was able to refinance and make it better. Let me say that one more time. So, when we had a low credit situation, he got in the house and locked in on the purchase price, but what he was able to do is when he locked in on the purchase price, even though his terms weren't the greatest, he was able to refinance later and improve his situation. Now, where does good credit start? As far as from a mortgage perspective, a 720 is really good. That's where you start improving your terms. And a 780 credit score is really when you start getting into exceptional. Now, if your credit is actually below a 620, it doesn't mean that you can't do it. It just means it gets exponentially more expensive. So keep in mind that if you have some credit that's in a tough spot, it's okay. It's okay to spend a little bit of time fixing it. You know, you can strategically get set up by understanding your credit, by going to annualcreditreport.com, maybe Credit Karma, understanding how your credit works, and actually help bring it up. We can have another video about credit at some point in the future. Now, keep in mind that the more risk you pose, the more it's going to cost you. So if you're under a 620, it's very likely that your down payment and your closing costs are going to be higher because of the perceived risk that you're bringing for this to the file. Now, you can go to a couple different places to get credit repair. There are for-profit institutions where you can pay somebody, I don't know, $100, $150, $200 per month, and they're going to help you get your credit cleaned up. Or you can go to a nonprofit version that HUD actually certifies, and so you can go to a HUD housing counselor, and they can give you some credit counseling. Now, keep in mind, just don't miss this perfect piece right here. It may not be perfect now, and I'll share my story. When I bought my first house, my credit wasn't perfect. It wasn't awesome. I was 24 at the time, and I just needed a house. I needed to get into the house. I was married. I had a child. I had one coming. It was time for me to get a house. Now, having said that, I don't regret buying, even though my interest rate was significantly more on the elevated scale. It was much higher than it would have been had my credit been good. I don't regret buying it all because I locked in a very good price on this home, and then years later I was able to refinance and improve my terms. That's really good, and it actually made it better. Now, before we go on from credit, just keep in mind that there's a lot going on right now with credit profiles. And Experian and TransUnion, they're not only monitoring people's credit, but they're also selling credit pulls. And there's a lot of lenders right now who are very desperate for business, and they're buying these credit pulls. So if you want to be eliminated from the robocalls, the robotext, and also the spam calls, you might want to go to donotcall.gov and add your name to the list there, and also to optoutprescreen.com. You will thank me later if you do that. Now, we've talked about credit. The second piece to the pre-approval that we're looking at is going to be income. Now, income gets judged a variety of different ways depending on how your income is structured. Just keep in mind with this very basic continuum that the more risk that the bank sees with your income, the more timeline they're going to want to see in order to be able to calculate that income. So here's what that means, is if it's variable in nature, like self-employment, like hourly, like maybe you're getting piecework, maybe you're getting paid by the mile if you're a driver, maybe you're getting paid as a mechanic by the piece that you're doing or what you're getting done, or piecework in manufacturing. All those are going to require a timeline to be able to prove that that income is steady, that it's stable and that you know how to sustain it. And that's actually pretty important. That can be a timeline as much as 24 months or 2 years, or as little as 12 months, depending on the type of income. Now, self-employed, for the most part, you're going to be looking at 12 months. And the downside with self-employed is that you really have to have 2 full years of tax returns in order for us to be able to calculate your income. And it's an average of 2 years. So if you have a really bad year 1 year, the next year is going to have to be tremendously good, or you might want to wait an additional year to kind of even out the playing field with your taxes. Now, the most predictable version of income is salary. Salary is amazing. It's the same next week as it's going to be this week, whether you work 40 hours or 80 hours, it's the exact same amount. So just keep in mind that's the most predictable piece. And once we're done looking at all of your income, we're going to compare that to all of your debts. Now, we're going to look at the debts from the standpoint of what do you have on your credit report? So car payments, credit card payments, student loans, child support, collections, homeowners associations if you're going to be buying a home in a homeowners association, and there's quite a few other ones that can be added. This is not an all-inclusive list, but in essence it does give you a good idea of what it is that we're going to be looking at, because the debt to income proportion tells us not only how much debt you have, but how much house you can support on top of the current debt load that you're currently carrying. So that's a pretty big and pretty important piece when we're looking at income. It's not just about how much you're making, but how much your debt load is in comparison. The last thing that we're going to look at when it comes to pre-approval is going to be your assets. Now, the assets, a lot of people think, well, I have a car, that's an asset. I have a ring, that's an asset. Okay, well, those are good, but those aren't liquid assets. We're really looking for something that you can liquidate in a fair amount of time in order to be able to use either for down payment or for reserves, meaning savings after the fact to prove that you're not going to be destitute and you can still feed yourself and go to work. That's what we're kind of looking at. So what are some of the assets that we can use? We can use savings. That's the most common one. So checking, savings, anything that you might have saved in a bank account. Now, this is pretty important because some people like to carry cash around or have a safe at home and they put the money in the safe. That cash is not something that we can use because we can't prove the source of where it came from. We don't have a paper trail to prove where it came from. And anytime you deposit cash into an account, it can create an issue. The reason is because the minute you deposit cash, which we can't prove the existence of or where it came from, now you trigger money laundering protocol, which requires us to take a step back and identify where that cash came from, or we have to discount it all the way. Now, there's a whole lot more to that, but let's not dwell on it right now. The main piece about it is don't deposit cash, and anything that's in your savings for over 60 days we can use. So 60 days is the general timeline. So savings, checking, 401k is a good place that we can go as well. Many people take either a distribution from their 401k or they can take a loan against their 401k in order to be able to buy the house. Both of those are actually pretty decent ways to go when it comes to buying the house. Stocks are also a very good opportunity, and so are gifts from family members. We see a lot of people who go to grandpa and grandma who are willing to give you a little bit extra money to be able to help you with the purchase of this home. And so I would encourage you to probably talk to family because you'd be surprised at how many people get help when it comes to buying a home. These are pretty typical ways of getting the cash. Now let's talk about the typical timeline and the typical way that the steps for the pre-approval, generally speaking, work. Generally speaking, if you're going to go out and buy a home, you're going to need to call me or another mortgage professional within a very short amount of time to get out there and get completely oriented and set up on how it is that you want to buy this home. And the typical steps that you're going to be going through is first you're going to have to fill out an application. Most commonly that is done through a secure online portal, and then you're going to upload some of the most basic documents. And these are basic financials, so pay stubs, W-2s, tax returns, your asset statements for whatever bank account or 401k that you're planning on using during this transaction, stocks. If you do have a gift that's coming in, you need to identify how that money is getting paid. And then what's going to happen is once that comes in, the mortgage team is going to pull up that application. We're going to look at it page by page. We're going to look at all the data points that go with it, and we're going to establish the data integrity, make sure that there's no typos, make sure that all your credit, income, and assets are adequately portrayed in the file. And then we're going to set up a time to review it with you. Now, this is very important. Not a lot of the loan officers do this, but this is extremely important that you meet with your loan officer to review your file. And the reason being is because it's not just about checking the data to make sure that the data is correct. It's also reviewing the data to make sure that you can set up for a strategy session on purchasing the house. And this is extremely important because a strategy is really going to be talking not just about your payments, not just about your closing cost or the legal fees for the transfer. It's also going to be talking about your cash to close. It's also going to be talking about appraisals. It's going to be talking about negotiating, your latitude that you're going to have with negotiating, some form of an appraisal strategy to try to get past if you have to get into a competitive situation and maybe offer a little bit more than what the purchasing price is. These are all pretty important pieces that you want to make sure that you're discussing with your loan officer. And so, yeah, the meeting, we're going to talk about payments. We're going to talk about closing costs, which are the legal fees. And in these closing costs, there's actually three general categories. There's the APR fees, which generally refer to the labor or the manpower that the title company and that the mortgage company is going to be putting into this loan transaction to transfer the home from the seller's name over to your name as the purchaser. Then there's the non-APR fees, like the appraisal and taxes and tax transfer costs and other items like that, that all happen from the county courthouse perspective to legally move the home into your name. And then there are the prepaids, the prepayment of the taxes and the insurance. This is actually pretty important. You want to make sure you get all of that stuff lined up so that you understand what your obligation is as you're going into this transaction. You also probably need to understand whether you're going to be hiring a realtor, but we're going to talk about that in another section because the National Association settlement actually might bring you some financial consequences there as well. As the realtor now, you are the one that is obligated to pay the realtor for their commission on this side if that's where you decide to go. Now, once you're done with reviewing all these pieces, you want to understand how much negotiating latitude you have and the appraisal strategy. Because if you're going to be offering more than what the purchase price is because you're in a competitive situation, you love the house, it has that perfect little white picket fence, it has a beautiful mailbox, it's right near the park, right near the coffee house, whatever it is that you're trying to get next to, just make sure that you understand what your negotiating latitude is, and if you were to offer over the purchase price, what might actually happen with the appraisal. Now, these are all pretty cool pieces to understand because if you don't understand them, you could get in under contract and have a lot of surprises. So this is, generally speaking, the first step. Once you've gotten this full step completed, that's when we issue you the pre-approval letter, which is when you go out and start getting ready to shop for that home. Perfect, Orlando. This is exactly for you. Make sure that you're prepared and you meet with your lender first. So step number two. Step number two is really important for you as well. And this one, actually, you can involve a realtor if you'd like to in this one, but it's probably best to spend a little bit more time at home discussing these pieces right here because you want to understand what your goals are. You've just gotten through the financial goals. You've just gone through the financial refining. You know what it's going to cost. You know what it's going to take to buy this house. You have some negotiating latitude. Now is time to establish your goals with a home type and how you're going to use this house. That's pretty important because if you're looking for a single family with a nice little picket fence, well, that is certainly a very specific criteria that you want to make sure that you have set aside so that you're not looking at condos or townhomes or multifamily, which are also part of the housing market. And you can actually get set up for a condo. I mean, a condo's not a bad idea if you're looking to lock and leave and go to the beach or go to the mountains every other weekend. Or maybe a townhome that has limited maintenance. Or maybe you want to turn into a real estate investor for your first purchase and buy a multifamily. That is pretty common. We have a lot of people who like the multifamily version because they can buy a multifamily, live in one unit and rent out the other units and gain enough income off of that so that their payment is actually next to nothing. And you can get up to 4 units at the same time with that type of program and that type of mindset. So it's not a bad idea, but you have to decide because not everybody's ready to be a landlord at the early age or at the late age or at any age. So you have to kind of decide if that's the place you want to go and decide which type of home and what your use is going to be with that. Now, there's two additional strategies that you need to consider with this home, because these strategies are really going to help you decide and refine how you purchase the house. Everybody wants a really perfect house for every situation, but you need to understand your entrance strategy and your exit strategy. Now, here's the reason why I say this. You need to identify what your real needs are with the house. Do you need 3 bedrooms? Do you need 2 bedrooms? Or do you need a garage, or is that really a want? Do you need a fenced backyard because you have fur babies that you need to let run out in the backyard, or babies that you need to put a swing set up for? Or is that just something that may not necessarily be as important? Or is it important to be near the coffee shops in the cool part of town or downtown where you can walk to places? Because that's going to help you set budgets and help you understand your monthly payments and make sure that you're setting yourself up for success. That's going to play hand in hand with the mortgage pre-approval, is understanding what you're trying to accomplish with these pieces. Now, the reason why you want an exit strategy is because the first house tends to be the house that you don't necessarily stay there forever, and understanding how you're going to exit that home long term actually makes a whole lot of sense. Because if it's going to be the first of your rental portfolio, that means that the house doesn't necessarily have to be perfect to live in, but it does need to be a perfect rental at some point in time once you're done with the house, because it's a very temporary house, and it's certainly something that makes sense if you're going to keep it, to turn it into that rental, to look at it from the standpoint of what is the longevity of this house, what is the maintenance of this house, what are some of the other factors that play into that. No different than if you're really just looking for that perfect home, and then your plan is to sell this house and then turn it into a stepping stone for the next one, because now you're looking for a place where you can get quick equity, or equity that can build over time, so that when you sell it, it's a very desirable area and you can turn around and maximize a maximum impact of your use of this home. So these are really important pieces. Like some people, they buy their first home and they plan on living there for the next 40 years, and they're going to be buried by the tree and back. So that's a completely different strategy as well. So keeping in mind that there are 3 main components to establishing your goals. Number 1, the home use. Number 2, the entrance strategy. And then finally, the exit strategy. Now, when we get to step number 3, this is a step where we start shopping for the home. This is where the financing track now starts to merge with finding the house and purchasing the home. And it takes a lot of work to get all this going. So here's what's important with this stage is, if you're going to use a realtor, now's the time that you need to invest in a really good realtor. Not all realtors are created the same. Some are very good at negotiating, some are very good at relationship building, and you really need to determine what it is that you're looking to do. And also, with this National Association of Realtors settlement that just came down, commissions has brought to light the need that you really need to make sure that you know what you're getting for this relationship, because you're likely going to have to pay for it if the seller is unwilling to contribute towards your agent's commission. So just keep in mind that you're looking for somebody who's going to be vested in you, somebody in your transactions, somebody in your needs, and not necessarily in just the cash flow that they need in order to be able to pay their mortgage or whatever else is going on. So I work with a lot of really good realtors, and I worked with some bad ones in the past, and I just need to let you know that they do exist. So spend a little bit of time interviewing. Make sure that you understand who it is that you're getting in with, and make sure that you set yourself up for success. If you do need some input, I have a list of people that I have had really good experiences with, no strings attached. Happy to send you that list and you can talk to them. Keep in mind that because the seller is not paying for these services, it's now on you, and there is no guarantee that the seller will cover these things. So you have to ask what the fees are going to be for the typical realtor, or what the typical realtor is going to charge, and what the services are going to be that they're going to be vested in serving you with. That could add a cost anywhere from limited services for, I don't know, a couple of $1,000s, all the way up to 3.5–4% of what the purchase price of the home is. So 3% of a $400,000 home could be $12,000. So you really need to understand what it is that you're going to be getting as far as the services. And then at the same point in time, you need to understand that if you're like, no, I'm just not going to do this, that maybe flying solo might have some risk, because in real estate, the devil is in the details. There is a lot of details when it comes to buying a home, and they are not always intuitive. Now, having somebody who might be able to help you would be a good idea, but if it's simply not feasible to do that, You might want to check out some of the sites that are springing up where they can help you as you go to buy, but just be careful because it is not an intuitive process. You want to make sure that it's very comprehensive and that you're not setting yourself up for success. And we're going to talk about some of that right now, what the steps are. Once you've selected the realtor and you've defined their job description, make sure that you tell them what it is that you want help with. You've already discussed, you've already set the goals for your housing, you have a really good idea of what it is that you need done, and you define the job description with this realtor and you agree to whatever it is that you're going to be paying them. Now, all realtors nowadays, especially after the settlement, are going to be having you sign a buyer-broker agreement. This buyer-broker agreement is going to pretty much delineate what the services are that they're going to be doing for you and what the cost is going to be yours and what you're going to have to cover in order to be able to move forward with them and helping you buy this home. Now, some of it can be as much as just opening a door, some of it can be negotiating a contract, or you can get the full concierge service. That's really up to you. Make sure you interview them and tell them what it is that you need. You've already established your housing goals, so expressing that to them is actually going to be very simple. Now, your realtor should be somebody that you consider to be proactive and constantly is looking to help you find a home that is either on market or off a market that will suit your needs. So this is pretty important. They will connect you up to the multiple listing system where all the other real estate professionals in the area are going to be listing their homes and are going to be putting them on this multiple listing system so that you can take a look at them. The agent will send that to you. They'll hook you up to your own portal and define on whatever area it is that you're looking to do. And maybe it's right by one of the great theme parks in town. Who knows? Maybe that's where you want to be, because if you're looking at it from an investment standpoint and that's going to be your stepping stone, maybe it's that you're going to convert it to a rental once you vacate the house. That's a great way to think about it. But anyway, it's up to you. You can kind of decide how you want to do that. That multiple listing is going to give you geographic areas that they're going to connect you to. It's also a good idea to go to open houses and maybe visit new construction as well. Regardless of which way you decide to go, once you found the house, you need to move quick. And the reason I say that is because there is a lot of competition right now in the market. It has possibly slowed down a little bit, but that competition is literally going to be jumping in and looking at some of the same homes that you are. And it's very likely that you're going to see some competition as you try to make an offer on that home. Now, save yourself some time. You've already identified the criteria that it is that you're looking for with this house. You've already identified that. So when that cute little house pokes up that doesn't really meet the criteria, but oh my God, it's really cute, save your time. Save your time. Don't go look at it because it's really enticing you into something that doesn't really fit your needs. Now, the next stage is once you have found the house, you want to make sure that you're making an offer. So make an offer that you do understand. I would encourage you to read the real estate contract before you make the offer, fully understand what your costs and obligations are, and keep in mind that these contracts are designed so that they can actually help you meet in the middle and come to an agreeable solution where all parties are trying to make this transaction help. The buyer's trying to buy, seller's trying to sell, and everything else can be negotiated. When you start negotiating the offer, you usually write your offer out and you send it to the listing agent or to the seller. And there are really three outcomes that you can see with this offer coming in. Number one, they love the terms, they decide that they're going to work with you, and they ratify the offer. Well, that's awesome. Nothing else to be done. We move on to the next step. But there is a second possibility. Maybe they really like your offer. They think you're almost there, but maybe they want something slightly different. So they're going to counter offer back to you, and they're going to ask you to complete something else. Maybe they want a little bit more money. Maybe they want you not to do X, or maybe they want you to do Y. Those are all parts of the counteroffer that you can actually go through. And then that just means that you're going to go back and forth until you either find a mutually agreeable solution or you decide that you're just simply not going to move forward with that house. And those are options that you can choose to do. The third option that can happen is that they can actually reject the offer. Now, this rejection just doesn't mean that they're not interested in selling to you. It doesn't mean that they're violating fair housing. It just means they didn't like your offer and they probably want something changed on it, and that was the best way for them to just kind of make that happen. Sometimes this can be completed quickly. Sometimes this negotiation takes time. So what is the seller usually looking for? Well, they're going to be looking for the same thing that you would probably be looking for if you were selling your house. They're going to want to be looking for, number one, net. What am I going to make on my house after I'm done selling it? I have to take out the mortgage. I have to take out what I'm paying the agent that's representing the seller. I have to take out the agent that's representing the buyer. There might be some legal costs in between. What is my net? So when you're looking at your offer, you need to make sure that you're considering what that net is on the home. The next thing you need to be looking at when you're making an offer to the seller is how clean is your offer. What that means is, no, we don't put bleach on it, but it does mean that what we're going to be doing is making sure that the contingencies are at a bare minimum. Are you trying to nickel and dime them on the repair cost of the home? Are you going to be guaranteeing them a certain amount of money if the home doesn't appraise? What is it exactly that you're going to be offering them? Is it contingent upon the sale of something? Are you trying to sell a boat or a car to get the funds in order to be able to buy the house? That's all part of what they're going to be looking at when it comes down to clean. Now, the last thing they're going to be looking at is timelines. How quick are you going to make this happen? Maybe they have a home that they're building, or maybe they have to move to another state. God forbid, Florida's the best place to live, right? But it does happen that people have to leave Florida. And so in that case, they may need a quick closing. You may need a lender who can close in 2 weeks, because that's the competitive solution that this seller needs. Those are all parts and pieces that if you have a really good realtor, they're going to be digging and finding out how to negotiate this offer, find out what the angle is so that they can structure your contract in a great way to help you set up for success. Otherwise, if you don't use one, you're going to have to find it out yourself. Now, what are the best practices with some of this? Number one, don't include any sale items with a house, like a lawnmower or like a pool vacuum or other items like that. Make that on a bill of sale separately. That really complicates the mortgage up quite a bit. Now, once you get going with this, have your conversation. Here's a really good piece, especially if you're getting into, this is a pro tip right here. Pro tip, big pro tip, make sure you're paying attention to this one, because if you're in a competitive situation, this piece right here could help you and make the difference for you. Number one, best practices. Make sure that you have a three-way conversation before you put the offer in with your loan officer, with the realtor, and with yourself to understand, number one, how quickly can the loan officer close? Number two, what is it that the seller is asking for? That's coming from the realtor. Number three, what happens if I offer over top of the list price? Will the home appraise? Will that make sense in order for us to be able to go forward and actually pull this off with that kind of scenario? And so that's a very strategic phone call that is completely worth your time in making sure that you have this conversation before you put your offer in so that you can strategically set yourself up for success. Now, that doesn't mean that you can make a poor offer and expect to get it ratified and still have this conversation. It means that you need, if you're really looking to make this happen, you need to take the advice and you need to see what you can do to best get the angle and put that in there. Put your offer in there in a very net, clean and quick way. Going back to the three things that the seller is looking for: net, clean, and quick. Now, let's say that you have success and we are ratified. If you're not ratified, obviously you're just going to go back to the next and just go to the next house after this one. But let's say you do have success and you are able to move forward and ratify this contract. This is fantastic, and now we are on the fast track. Really need to move very quickly because there are so many parties involved when it comes to getting a loan transaction done. You're under contract, so this is where we begin to weave in and out between what the realtor is going to be doing, and we're going to weave in and out between what the realtor and the loan officer are doing as we go through this process. Keep in mind, it's not just the mortgage company, not just the realtor at this point. There's about 40 different people who are going to be touching this file before, during, and after as we're going through this program. So just make sure that you know that time is of the essence with everything that happens. So there's a mortgage company, there's a realtor, there's an appraiser, there's a title company, possibly a title attorney, home inspectors, insurance companies, utility providers, sometimes a surveyor, structural engineers in rare cases, and obviously once everything's done, we have to go down to the city or the courthouse in the county and register you as the rightful owner. So moving quickly is extremely important. One of the big things that happens immediately upon ratification is that you're going to put up a earnest money deposit. Now this earnest money deposit is usually between 1% and 2% of the purchase price. So that means if you're buying a $400,000 home, that earnest money means that you're giving $4,000 to $8,000 to the title company, not just so the title company can begin the work, but it's also to guarantee to the seller that you are pretty doggone serious about this house and that you're going to make this thing work. Because if you default and you decide to back out for no reason that's contractually supportable, that money's going to go to the seller. It's going to be theirs. I have seen, many times I've seen, that the earnest money deposit, the serious nature of this and making it larger, can be the tipping point in making sure that the seller selects one loan or one purchaser over another. That's a really big deal, something worth looking at. So do you lose the money when you do the earnest money deposit? The answer is no, you don't lose that money. It actually gets applied to closing once you get down to the closing part. Now, as you move forward with this, the next step really is getting the loan disclosures out. And the loan officer is going to review interest rates with you. They're going to review the final numbers with you, and then they're going to send you out the loan disclosures. In these loan disclosures, they have to send them to you within 3 days of the contract being ratified. So this is extremely important, and there is a very specific timeline. So just keep in mind that these are living documents. It is completely normal to get them and to see a couple typos or to get a few things that weren't filled out correctly. And then what you want to do is make sure that you clean those up. A simple email to the loan officer is actually pretty easy in order to be able to pull that off. Keep in mind that what you really want with these documents is that they be 100% completely done and perfect by the time you reach the closing table, which is approximately anywhere from 10 days to 30 days later. At the same point in time as we're doing this, the realtor is going to be contacting the homeowners association, and they're going to be asking for the homeowners association packet. Now this packet is extremely important because this packet is going to tell you what the conditions are of the homeowners association in that neighborhood, if you have one. If you don't have one, we can ignore this part. But if you do have one, keep in mind that this is actually a pretty important step, because you have a time frame of 3 days to review this packet once it has been received and accept it and move forward, or reject it and cancel the contract. It's a no questions asked. They can't get you to waive that timeline. You get a get out of jail free card if you don't like the house in the first 3 days after receiving the HOA packet. Now keep in mind that if you received it and you don't do anything with it and you review it after the 3rd day, you are stuck. It is entirely yours, and there is no waiting period past that 3 day. Simultaneously, while we're doing this right here, the loan is now moved into the processing portion. And in the processing portion, what's going to happen is there's a processor on the mortgage side who's going to be reaching out, gathering some final detailed documents, asking for clarifications, maybe fixing some of the clerical errors, and they're going to be packaging the loan to be able to send it off to the underwriter, which is going to happen in a couple stages, and the underwriter will end up reviewing this package. What they're going to be doing is making sure that all the data is in there paperwork-wise, because the appraiser is not going to talk to you like the processor is. They're not going to talk to you like the loan officer is. Instead, what's going to happen is they're only going to be looking at the paperwork. And so it's extremely clear that we paint a great picture, or what we do and what we call in the mortgage world, create a great structure so that the underwriter has the ability to look at these items and to make a decision that it does follow the guidelines as needed. So the processor is putting all that together. At the same point in time, we need to engage the insurance company. Now you can pick any insurance company you want. You certainly can use Geico, Allstate, State Farm, Progressive, USAA. There's a ton of insurance providers out there. In Florida, it's a little trickier, but at the same point in time, insurance is a big deal, so there are outlets that are available down there. You want to get a quote, you want to do whatever inspections that they have, and you want to get set up for success based off of whatever that carrier is demanding. And obviously, if you can bundle it with your car, maybe there's a savings involved with that, so it might be worth your time. Simultaneously, as we're doing this, you can see there's a lot happening at the same time. Simultaneously, you want to engage a home inspector. Now, this is extremely important because a home inspector, it sounds like you might be wasting your money because they're bringing chicken outlets and other things, and I can see that if there's a problem or not. This home inspector can be make it or break it. because they're going to be looking in places that you're simply not going to go. If there's a crawl space in the house, they're going to be looking in the crawl space. If there's an attic, they're going to be looking in the attic. They want to make sure that the condition of the home is completely set up so that you're not going to have major deficiencies after this is closed. Now, I'm going to share a very specific story here about somebody that I served that actually got a very bad home inspector. And the home inspector, he was, I don't know exactly if it was a matter of incompetence or if a matter of negligence or what exactly the problem was, but he missed something in the crawl space of this home that should have been caught. And the client ended up having to tear out the entire back wall of the house because the wall was rotted out. And quite frankly, it was a $40,000 fix. It was terribly expensive, and it certainly was a legal problem for the inspector. So it's a good idea to make sure that you interview inspectors, that you know what you're getting into, and that you set yourself up for success by getting an inspector who's going to help you with the condition of the house. That's what they're really tasked with doing. They're going to point out every deficiency, and then once they've done that, you have the ability to go back and negotiate the outcome with the seller. And those repairs can be something that maybe they're minor and you just want them to give you $50 to repair the outlet, or maybe they're major like this last one and you want them corrected, or maybe we're done. We don't want anything to do with the house because it has so many deficiencies that we're just simply done with the house. Those are all possibilities. You can choose to fix, you can choose to get a credit, or you can choose to walk away in most cases. Now, make sure that you're not waiving these rights, because sometimes in a competitive situation, you may say, well, it looks great, I'm just going to go ahead and do it. Be careful with that, because many times there are hidden pieces that you don't see and that haven't necessarily been touched. As far as inspections are concerned, you certainly want to do one for the condition of the home. Sometimes insurance is going to require one. Sometimes you're going to need one for pests, termites, wood-boring beetles, other items of that nature that might be infiltrating the home and damaging the home. Maybe you want a specialty inspection like radon, or maybe you want to do some other type of inspection that might make sense at the time being with an engineer. Maybe there's something that isn't right, or you want a structural engineer to look at something because it doesn't seem good. Those are all parts of what you can do during this inspection process. And once you get those reports back, once again, you can negotiate them. You can negotiate the repairs, you can negotiate credits, or in some cases, if it's egregious enough, you can walk away. While the inspections are going on, at the same point in time, the mortgage company is going to be contracting with an independent appraiser. Now, the job of this appraiser is not really necessarily to look at the condition of the home, but that does play into it. They want to make sure that it's at least safe and that it is habitable, but they're really looking to see if the value and the condition of the home actually support the purchase price. Now, the appraiser, what they're going to be doing is they're going to be going into every room of the house, and they have to do a head and shoulders inspection to make sure there's not an, oh my God, what happened there? And if there is something like that, they may make a note that it needs to be repaired prior to settlement. Some of the things that could affect the appraisal would be, sometimes we see that if there's an appliance that's there that isn't working. So one of the rules of thumb that the appraiser is looking for, if it's there, it needs to work. Other than that, for the most part, if something is deficient, they are going to be requiring that the appraiser go back out and recheck it to make sure that it has been corrected prior to settlement. Now, what are some of the outcomes that we could see of the appraisal? Well, the appraisal, what we usually see is that the appraiser is going to be going out and checking on the value, and if it comes in right at value or above value, meaning your purchase price is $400, it comes in at $400 or above, perfect, you've got instant equity, we move on. Let's just say it does come in a little low. That does happen, but when it does happen, you do have some opportunities to be able to try to get it corrected. Number one, what you can do is you can actually challenge the appraiser. You can go and try to find some of the information that maybe the appraiser missed. They are human, sometimes that does happen, they miss things. And you try to present that to the appraiser and make sure that it is information that maybe he didn't consider that might be able to help bring the price back up. Some of that information may have been missed, or maybe additional comparable homes that maybe the appraiser missed as well. Those are items that can be added back in and can be brought to the forefront to try to bring that value up. Depending on the contract, what you end up finding is that if it comes in right at value, it's not a big deal, everybody moves in, but moves on. But if it comes in low, you have a couple different options. Number one is you have the right to renegotiate to an agreeable solution between all parties. So if you were buying the home at 400 and the appraisal came in at 395, you have the ability to renegotiate and maybe lower the price or come up with some alternative method if you really like the house. So number one is reduce the price. Number two is pay the difference. That's the alternative method. Maybe you can split the difference or pay the difference, and you really need that's really going to be dependent on the competition that you have on the house. So what that means is if you have 10 people who are buying for the same home and you guarantee that you're going to be buying the home at 400,000, if the price comes in at 395 based off the appraisal, it doesn't mean that the home isn't worth 400. It just means that the appraiser, based off of the historic data, because he's looking behind, he's not looking to the front, not where the market's headed is where he's looking at what happened in the past. And so what happens is if you've guaranteed the 400 but it comes in at 395, then based on the competition, you guaranteed it, now you're going to have to pay the difference. So that's something that you just kind of keep in mind, and it is something that you really want to talk with your realtor and your loan officer about to make sure you know what the implications of that are. So the third one of these is that you can terminate, and that depends on the terms of the contract and how you set it up. But most commonly, if you don't change the boilerplate in the contract, you have the right to negotiate, you have the right to pay the difference, or you have the right to terminate. While this is happening at the same point in time, the mortgage underwriter is going to be reviewing all the items that are in the loan. Once again, they're just going to be looking at paper. And so in essence, they're going to be considering everything that happens in the file based off of the paperwork and the data points that are put in. If there is going to be a problem, it is usually at this stage because bad pre-approvals tend to show up in the underwriting phase. This is when all the document checking starts happening, and this is where if anybody failed to get the data points correct, this is where it starts showing up. Sometimes it's because of the failed data points. Sometimes it's because of additional overlays or additional requirements that the bank is adding that are not necessarily items that are required by Fannie Mae or Freddie Mac's guidelines. So that's something that's really important to understand. The underwriters are going to review as an independent party against the loan guidelines, and they're going to make sure that you're set up, and they're only going to be reviewing documents and making sure that everything conforms. If it conforms, they're going to issue you what's called a conditional approval. Now, the conditional approval, what that usually means is that, hey, congratulations, the home is almost yours. If you satisfy A, B, and C, we're done. You can take possession of the home. So that's actually pretty good. Sometimes they're really minor conditions. Sometimes, depending on what happened with the pre-approval, there might be more conditions. So keep in mind that the failure to get the data points is actually extremely important, and the strength of the pre-approval really does mean a lot. Now, getting those conditions satisfied, time is of the essence. We want to make sure that we get those done as quickly as possible so that you can move on to resubmittal, which is where they review the final conditions and they give you the clear to close. This clear to close means that the loan is all done. It means that you don't have any more paperwork to do, but it doesn't necessarily mean you're totally done. What it means is that the loan itself is done. There are still some federal things that have to happen. For example, a closing disclosure is going to go out, which has got a federal mandate with it. They want to make sure that you've had a chance to review the documents, that you've had a chance to review the closing cost and everything else that's associated with the loan. This is a 3-day period that you cannot get around. And so it's extremely important when you get that closing disclosure in your hands that you go ahead and look at it, review it, and sign off on it. If something's not right, make sure you address it quickly because any delay could delay closing by at least one more day, or if not even further than that. So keep in mind that that is the trigger for closing, even though the clear to close may have happened sooner. Okay, sometimes the closing disclosure does go out earlier than the clear to close. It can go out as soon as 8 days before closing. That's the soonest it can go out, and no less than 3 days before closing. So this is extremely important that you pay attention to that and that you get that signed off as soon as possible. Simultaneously, while this is happening in the real estate world, going back to the real estate world, you usually have a final walkthrough. And that's where you go into the situation of walking through the house now that the home has been vacated, and you get a chance to inspect the home to make sure that when the seller moved out, that they left it in as good of condition as the date in which you contracted on it. If there are repairs that were guaranteed to be done, you're kind of expecting those to be done at the same point in time as you're doing that final walkthrough. So it's pretty important. Don't expect them to do anything after closing. It is not going to happen. Anything that is left behind is yours, and so you need to make sure that you know what it is that they're leaving behind. And one of the houses I bought, they actually left the kids' wagon behind. Now my kids loved it, but they left the kids' wagon behind. And I could decide at that point in time whether I even wanted to give it back or not, because they left it in what is now my house. So keep in mind that if they leave garbage behind, it's yours. If they leave a trailer behind or a wagon behind, it's yours. And the same thing happens with repairs. If they don't repair the home at that set time, it's yours. So keep in mind that that's a pretty big deal, and you want to make sure that all that stuff is taken care of in the final walkthrough. At the same point in time, in your home, you need to make sure that you start moving the utilities over and putting the electric and the water and the sewer and the internet into your name. That's actually the biggest part of the transaction, is getting everything done in this process of buying the home. So this is the shopping and buying portion of the home. And wow, there's a lot of detail that goes into this. You can see why many times you're going to want to have some form of representation, or at least some form of a guide that can help you get from the beginning all the way to the end and not miss any of the details. Step four is actually a pretty magical time, because this is where you're getting to the point where you're going to be moving into your new Florida or Orlando home, and this is going to be so exciting for you to get in there. But there's a few extra steps that you do have to take as you're going down this process. Step number one, you need to make sure that you know how the title company or the title attorney wants the funds for the down payment and the closing costs sent to them. Some of this can be done through a cashier's check, but many times if it's over $10,000, most of these companies are going to require that you wire the funds to settlement. Now, that's pretty important, because that can't happen usually the day of settlement, so you might have to do it the day before to make sure that you get it there in time so that there's no hiccups and no slowdowns for the day of closing. Now, at the day of closing, if you take a certified check, not a personal check, but a certified check, or whether you wire the funds, you still need to go in person, and you need to bring your identification so that you can go ahead and sign on the dotted line. This is fantastic. This is a time of celebration, and this is a great time to help you get into the house and make great and new memories with it. Now, the typical timeline from the beginning of the contract until the time you actually close on the property can be anywhere from 10 days up to about 45 days, depending on what the market is requiring. So this is pretty important. This is pretty fun. This is where you sign on the dotted line. It can be a little scary because there's a lot of paperwork, and the reality of you owning a home is going to be pretty cool. Step number 5 is where the magic truly starts to come out, because this is when you start moving into the house, and this is where, if you have planned the process from beginning to end correctly, that you have zero regrets, and it's now time to celebrate your new home with wonderful and precious new memories for years to come. This is a fantastic time. It's usually worth probably paying for some pizza and maybe some drinks to have family or friends come over and help you move, or, you know, what the heck, just enjoy the process yourself. You've earned it. Congratulations on your new home. If you found this conversation to be helpful, you know, give me a thumbs up, give me a like, hit a subscribe. Love to hear from you. Leave me a comment. Maybe if you want something personal on your own place, or you want a consultation, don't hesitate. There's a link in the bio where you can set up an appointment. We can certainly talk about it. No obligation consultation for us to talk about your dreams, about your needs, and set you up for success. I hope to meet you and help you at some point in time as you move into the Orlando and into the Florida area. Thank you so much for the opportunity to serve you and yours in your new home.